So, good morning, everyone, and thank you for joining us. Hello, Luke. Lovely to see you again. So, today's session is a practical session, and we're focusing very much on professional development within the industry. And I'm joined today by Luke, who I'm sure will be no stranger to many of you. Luke, I'll just give you 2 minutes to introduce yourself.
Oh, thank you, Sue. Yeah, delighted to be here. Hello, everybody. Luke Scolthorpe, fellow of the Institute, used to be part of the senior leadership team with Sue, working for Sue. I've spent a lot of time with credit leaders for many, many years. Used to be a credit manager, United Utilities PLC. And what I'm doing now, I'm working for a corporate partner, my DSO manager, corporate partner of CICM, that is. And what we're doing is we're supporting credit leaders who are trying to govern exposure across multiple entities, currencies and systems, and without slowing business down. That is the objective. So yes, that is me, commercial director.
Thanks,
now.
Luke.
Thank you, Sue.
Perfect, thank you. And my name is Sue Chappell. I'm the Chief Executive of the Chartered Institute Credit Management. And what we're going to look at today are the practical challenges that are increasingly being faced by credit teams in a multi-entity, multi-global scenario in a world that is constantly changing with a fragile and uncertain economy. Teams need to adapt to this on a regular basis. So we're going to look at what some teams are doing, what can be done, and work through on that basis. We're going to run some polls because we're very interested in your thoughts, and there'll be plenty of opportunity for questions and answers. If you've got any questions as we're running along, if you pop them in the chat, and Becky will keep an eye on them, and we'll flow those through, and we'll also try and save some time at the end to cover off any questions if we can. So let's kick off then, Luke. Brace yourself, my friend. When organisations expand across multiple entities, which we're seeing quite a lot of now, including countries and multiple systems, what pressures do you see coming out first in the credit teams?
Great question, Sue. Yeah, what breaks first? We see it as a single version of truth. So the first pressure is not really more chasing. Okay, that might be the expectation. I don't know, or impression. It's that credit loses that single reliable vision of truth. So when you expand across multiples, the place where exposure can hide, it expands, it increases, and implementation. Our exposure to implementation shows that. So the team can still chase, they can still talk to customers, they can still do the basics. But the moment you have multiple trading entities, you get duplication of customer, you get fragmented ledgers, you get different payment terms you've got to deal with, different definitions of exposure as well from different regions, so different attitudes, and controls. Potentially they're going to remain local, where risk has really moved to a group level. And we also, to mention about predictable failure points, so you typically find customer master duplications across ERPs and entities, and inconsistent terms and inconsistent definitions of exposure. So one team measures exposure as, let's get into this, so they might look at it at ledger AR only. Others might include things like open orders. Others will include unbilled or WIP, might be called that, work in progress.
So I think I'm right in saying, Luke, there's a lot going on here. There's a lot going on for clients' ledgers. There's a lot going on for credit managers and credit teams. Whilst all this is going on, boards are still expecting predictable cash, managed exposure, all of the things that are needed for shareholders, internal boards, etc. Where are you seeing the tension arise against the expectations and the operational realities in the real life?
Yeah, tension shows up when the board asks a simple question, and the answer takes days. because it's retrospective working. So you're not working in real time, for instance. So the board expectation is that one version of truth that I was talking about. So that gives them that total exposure. It gives them the trend line risk and clean cash forecast as well. So they're expecting all of that. But the reality is the exposure sits across multiple ERPs. We deal with a lot of international trading businesses that have 6, 7 different ERP systems. Nothing centralized. It costs money to centralize, and they are merger and acquisition activities. That's how they're growing their book of customers. So they'll have multiple entity ledgers, they'll have multiple workflows, and a chunk of overdue. So it's managing all of the disputes. It's managing deductions as well in fast-moving consumer goods environments, and process failures. So the board sometimes don't know what the reality looks like, and that they're asking for insight, but what they're really asking for is that governance infrastructure, the definitions, the ownership, and the consolidated data. That's what they're looking for.
And I think one of the challenges that we see, and I know you will have seen it in your time as a practitioner as well as now, is one of the best and most required attributes of credit teams is resilience and the ability to do quite a lot with very little. And so many teams are equipped with spreadsheets, paper clips, and string, and making things work and producing good data and good performance, which then adds another layer of challenge to have the conversations about changing technology. So I think you've got some slides to share. Have you got some slides to share? Did I imagine that?
Yes, yeah, we not exhaustive.
Not exhaustive, but with a little bit
succinct
of detail. And so I think one of the things that's interesting is when we talk about credit management teams moving from that execution of the collections activity to more coordinated visibility shared across businesses. It's at what point does that happen? What's the optimum point? I'm interested in your thoughts on that.
Yeah, the tipping point. Yeah, the moment risk is distributed across entities and systems. I think that's the tipping point, isn't it? But by the time you're chasing, the risk has already been created upstream. Through all the order acceptance, the delivery performance, invoicing accuracy, billing integrity, pricing and deductions I mentioned, and dispute discipline, and credit authority overall. So yes, so that's all to be taken into consideration. I suppose the slide here is sort of dealing with illustrating that rising complexity, those entities that are adding the currencies, the systems. So it's showing that scaling doesn't just add volume; it adds structural complexity. So it's all of those things that we're talking about. Each one creates a place where exposure can be misstated, duplicated, or missed. I was just going to mention about volatility in markets. So it was only this week that the US government have announced a temporary import surcharge of 10%. I don't know if you followed this. So that's something that is going to be imposed for the next 150 days at 10%, and that's effective from Tuesday, 24th of Feb. So reports are indicating also, a bit of further bad news, that there's a potential movement towards 15%. So those tariffs are going to be going up potentially after that 150-day initial period. So tariffs tend to show up in credit as margin pressure. So it's so the reprisal is repricing, it's short pays, it's deduction volume I've mentioned, it's the dispute volumes increasing, and it's stretched terms. It's your supply chain paying you beyond terms. That is essentially the reality.
Yeah.
So yes, so that was newsworthy commentary here for our conversation.
And we're seeing a lot of this, aren't we? Which of course at the end causes volatility and uncertainty in the market, which slows markets down. And we're hearing lots of clients reporting that, you know, their out targets, target clients are holding back because people are waiting to see what else might happen. Will it change again? And that's obviously going to flow through to investment that might be possible in credit teams as well. Shall we check if our audience are awake with the first poll?
Oh, yes, please, Sue. Yes.
Becky, over to you.
Thank you very much. So, first poll, everybody. So, how confident are you that your organisation has a consolidated real-time view of customer exposure across all entities and currencies? So, we have fully consolidated and automated, partially consolidated, limited visibility across entities, and no consolidated view. I'll give you all a few moments to select your option. Still coming in, a few more moments. Okay, that's wonderful. I'm going to close the poll now. Thank you. And here are the results. So the majority is partially consolidated, followed by fully, then limited, and then only 4% with no consolidated view.
Wow, so that's actually very pleasing and if I'm honest, a little bit surprising to me that over 20% have a fully consolidated view. That's excellent.
That is good. That's positive. Yeah, Sue, I'd echo that. So the majority were partial, so that would probably indicate that there's maturity, but possibly stretched. So consolidation actually exists, but sometimes it's manual and time lagged, and risk isn't lack of effort; it's that control becomes sort of retrospective. So you see the true sort of group position after key decisions may well have already been made. So the majority of people might be in that space. But yes, good to see, 1 in 5 or just over
and that's
of
a
our
really
participants.
Sorry, Luke. That's a really key point, because I think, we see many decisions amongst risk and in the credit teams made at a local level, the local credit team, and that can create hidden risk at the group level if it's not shared. And so without the tools, it's interesting how organizations are doing that and how they're mitigating risk in such a risky climate. And this isn't about selling my DSO tools, it's about understanding how businesses are managing and what other things are available to them to get this understanding, because this local decision made by people who have the local understanding and know the clients, know the suppliers, know all ends of it, but don't necessarily have access to the global view, the hidden risk. I'm interested in what you see in that area.
Yeah, it's commonplace. We see it often, and we see where you have systems in silo. You have, I think you seem to coin a phrase. So you've got all the information, but do we have the data? Do we have a data story? The systems that you need to be linking up in real time are your bureau information, so your business information. It is your credit insurance utilization, your coverage. Lots of credit teams across into Europe will have top-up facilities, so they won't just have one credit insurance policy; they'll have 2. Your credit policy, in fact. So, do you actually have a global credit policy? Do you standardize terms across that? How does that work? Who's got exposure to it? And what's your collaboration like with those other teams? So yeah, because you need to know how they're all performing you can't just understand your own entity, your own country. So that's another key area. So technology ensures that you can bring all of that together. One version of truth, as we've been talking. That's what you need to be thinking about. Do you have one version of truth? Yeah.
Sorry, Luke. And I think this is the nanya for all of us. I don't think anyone would dispute having one version of the truth. It would be a lovely place to be. One of the challenges is on the journey to getting there. How do you, assuming that not everybody's got those tools, and we know that circa 80% haven't, without slowing down the commercial activity, which of course is absolutely key, are there some relatively straightforward governance practices that you see that could help with that?
I'm getting a lot of feedback here. Yeah, cleaning your data. So master customer data needs to be cleaned at least every 6 months. Those local limits are approved independently. That needs to shift to a group-based, sort of economic group-based sort of approach. Open orders and unbilled exposure, that needs to be linked up. So you need to be linking, for instance, your commercial team's CRM. So they might be on, I don't know, Salesforce. That's quite a common one that is used. So you need to have not just your AR focus from an exposure perspective. You need to be understanding what's coming in from the orders, what's coming in from the commercial team. The dispute side of things, have clear definition. So have clear categorization framework. So make sure that you're clean on what is classified as a dispute, not delinquency. So you're separating everything. But yes, you're right, and I think you also coined a phrase, Sue, which we all see, and that's credit teams are very hardworking and they're very astute professionals who work with what they've got. They unfortunately work with what they got, and then there are so many solutions out there from a tech perspective that they've almost painted themselves into a corner where they do ask and do need some improvement from the tech side of things, but because they are performing at such a level, even justifying investment is particularly hard. But we see that day in, day out, and we show. We can show the solution. But there we go. Yes. So there's some points from me. Yes.
Thank you. So we've mentioned a couple of times today so far the volatile economy we're in, and the uncertainty and the random nature sometimes of some of the decisions that appear to be made. So I think many organisations that I talk to, annual credit reviews are rapidly becoming a thing of the past, particularly for insured companies, because that's just not practical. But from an operational and practical example, what kind of risks are you seeing manifest themselves in organisations that still do rely on annual reviews?
Yeah, they're certainly working with a lot of aged debt, so they will be the ones that don't have the trade credit insurance. There's only in UK, there's only 14,000 or just under trade credit insurance policies out there. So if you think about the scope of businesses who are trading, millions of businesses that are trading, who no doubt would be exposed to risk that needs to be insured. Also, there'll be also the businesses that will want to go to the bank and raise capital and get finance. So yeah, it's a bit of a strange one. Plus the market is it's prevalent, isn't it? There's all of the big insurers are represented in UK. Okay, but yeah, I mean, even when we think about bureau data, we've got to discuss that, because there are credit teams that are high performing. Yes, they will work with aged debt because they're not insured. Yes, they will look at all the bureaus and see what data they can profile against their ledgers from a business information perspective. But again, they have to justify the spend on that, the investment on that. And some of them will be innovative as we talk about, the workarounds. They'll register, sounds crude, but they will register as a starting point their ledgers on Companies House. So at least they will get notifications, retrospective, yes, but they will get certain information back that they can then start to work upon. The likes of strike-offs, they'll get notification of that, and they'll be able to appeal those if they're still trading with that business that's Companies House looking to strike off the register. So all sort of things like that, and other such sharing groups, so that they'll no doubt look at those forums, the credit circles, etc. So yes, there's outside of the digital world, there is certain, shall we say, data points that you can collate, and it's just time out of your day. And that's also something that you've got to justify.
Should we put this to the test with our audience?
Certainly.
Let's have a see what our wonderful audience are doing in this space. Becky, let's have the second poll, if we may.
Of course. Here we go, everybody. The second poll. How frequently is customer credit risk formally recalibrated in your organisation? So 4 options there: continuously, using behavioural data, monthly, quarterly, annual at financial review, or only when payment issues arise. I'll give you a few moments to answer that, and then we will share the results. Okay, a few more moments. Lovely. Right, I'm going to finish the poll now. Thank you, everybody.
Thank you, Becky.
The results are in. So 43% continuously using behavioural data, followed by monthly to quarterly, and then 17% only when payment issues arise, and then the remaining 13% annually or at financial review.
Thanks, Becky, and thanks everyone. That's an interesting set of results, and I'm guessing that there's some sector bias in there. I can't see exactly who's on the call, but we know that obviously some sectors have a lot more volatility than others, and a lot more insurance dependency. Construction is one that obviously springs to mind. But what are your thoughts on those results, Luke?
You flashed them up a little bit quickly. What was it? 43%. Yeah. I mean, that's reassuring, isn't it? I'm pleased with that. I suppose. Yeah, most people are saying that the majority that they're using behavioural data. Yeah, I'm pleased with that. I think that's.
And I think that's symptomatic of the economy we find ourselves in. I think most teams are having to find ways of getting ahead of the curve, whatever that is. So I think that's a good thing that there's more reviews going on. But I suppose one of the measures that organisations use, not the only one by any means, is DSO. How are you finding it? Again, in a period of volatility, we see disputes going up, we see payment terms extending, we see all of these clashing things which denote increased risk to us. How can organisations sort of separate out genuine risk, increased risk, from the day-to-day noise and contamination of increased disputes?
So you've got to separate the debt. So separating disputes from collectible and from genuine delinquent. So that's sort of classification that I would say. But yeah, DSO rising is a symptom. So the question is, what's inside it, Sue? So practical distinction here would be, so thinking about credit risk. So customer has the ability or willingness, they have those willingness issues. So what we see is promises to pay breaking. We see aging worsen consistently. We experience partial payments from customers, stretching terms across all those entities. So we classify the reason. So without a dispute classification framework, you'll probably take the wrong action. So you'll probably confidently take the wrong action. So chasing process failures or tightening credit when the fix is operational. So I think sort of turn DSO into an actionable story narrative. So once segmented, you can say this proportion of the book, of the debt, is operational dispute delay, and this proportion is true delinquency. And then the action plan becomes obvious. That's how I see it.
Okay, thank you very much. And I, we've talked a little bit about credit insurance. Are you seeing, and if you are seeing, where are you seeing the main disconnects between the day-to-day credit decisions that are being made on the ground and the insurance limits?
Yeah, we see commonly three places with this. So the first one is timing. So insurer changes a limit, but trading teams don't see it in a workflow quickly enough because they've not got the real time piece there. So the insurer notifications often sit in emails or portals. Okay, so while the ERP and the order release systems still show maybe old retrospective headroom. So there's utilization, there's false utilization that we're being shown. So without, I suppose, those automated feeds and alerts into your daily workflows, shipments, if we're thinking about international trade, shipments can continue, and they're under outdated limits, and potentially uninsured exposure could build up. Really before anybody realizes. So that's number one. Number two is scope. So that's where limits are held at parent level, but trading happens at entity level. So utilization is really misunderstood. And that's where credit insurers may issue limits against a group or an ultimate parent while sales trade with multiple subsidiaries. That happens quite a lot. Or it might be if hierarchy mapping is weak. So each entity believes it has capacity, yet combined utilization already exceeds cover. So the group unknowingly and unwittingly is trading overexposed. They're outside those insured protections. Yeah. And the third is exceptions. So this is overrides. So when these happen temporarily, these overrides do happen, they could become normalized. Okay, so if you think about you're pushing product out, the shipments being released, maybe to protect a key relationship, that happens quite regularly with the commercial team, I'm afraid. But then they're extending again, and maybe for quarter end revenue. Okay, so we do see that. And then again for, I don't know, logistics delays, something like that. So without those, I suppose, those dates of expiry and reporting on insured versus uninsured balances, then you're temporarily, flexibly, sort of quietly, you're becoming sort of permanently policied to that risk being outside those insured terms. Okay,
I'm glad you mentioned overrides, Luke, because it was one of the things that was on my list to bring up. And it's, at a time when commercial competitive edge, commercial flexibility is absolutely key. How do organizations, do you think, maintain that commercial flexibility to commercial edge without weakening the risk discipline when those overrides start to increase? And they do increase when there's kind of ad hoc decision making?
Yeah, we see it as explicit. So it's who's approved, why, and for how long. So I mentioned about the expiry period. So that's key. So every override, because it's not a bad thing sometimes having an override, but every override, it needs to have an owner. It needs to have that reason. It needs to have that rationale, and it needs to have a defined scope. So that sort of means documenting the commercial context. So the strategic account through to the supply continuity, the contract renewal, all those things, and approving that authority level and that time horizon. So that expiry date. So when all of that is clear, then really, Sue, that's when overrides stop being informal, favoritizing, etc. And they need to be understood by everybody. So they need to be understood by audit, they need to be understood by finance, sales, and everyone. So everyone's sort of accountable for those decision makings, those decisions collectively. The other point is measured. So how many, how much, how concentrated. So we've got to track those override volumes really as a portfolio, not as a sort of isolated bunch of instances or cases. So you've got to measure the total value above limit. Maybe you've got to look at the percentage of customers on override. You've got to look at the sector or the country concentration. You've got to look at the aging of overridden balances as well. You could get some patterns out of that. So patterns often reveal maybe structural issues, so pricing errors, weak onboarding at the start, unrealistic limits, for instance. So management fixes root causes rather than firefighting the symptoms. And I was just going to mention the expiry piece. So if you have auto review dates, so overrides should never be open-ended. I think that's the key message here. So you build automatic review cycles. So you tie those into time or behavior. So I don't know, 30, 60, 90 days, or after a payment milestone, something like that. So yeah, that's how we see it. That's how we see that commercial flexibility piece, how that all fits in.
Great, thanks, Luke. Let's have our final poll then, Becky, if we may.
Absolutely. Right. So third and final poll. Here we go. So which area most distorts your organisation's cash performance reporting today? So first is disputes not tracked systematically, insurance limits not synchronised with credit limits, fragmented ERP reporting, or customer hierarchy and group exposure gaps. I'll give you a few moments to select your option, please. Okay. Wonderful. Just a few more moments. That's what's coming in now. Great. Okay, thank you, everybody. I will end the poll now. And here are your results. So, joint first with disputes not tracked systematically and fragmented ERP reporting, both at 35%, closely followed by customer hierarchy and group exposure gaps, and then finally 5% of our audience, insurance limits not synchronized with credit limits.
Well, I'm very pleased to see such a small percentage of unsynchronized insurance limits. What else shouts out to you from those results, Luke?
Yeah, very pleased with that. Very pleased that the coverage utilization is being tracked. They're going to be getting alerts. But how are they? Are they automated, or are they sitting somewhere? Can everybody see it? It's that sort of thing. Maybe there's a further question to be asked there, Sue. It's very that's again very positive, very positive. We have a mature market presence on this call. Yes,
which is very encouraging, and we will have a lot of CICM members and qualified credit individuals on our call, which also adds to people doing the right thing at the right time. When you're working with businesses, what do you see that they underestimate most in tackling strong credit governance across the mixed entities? Because it is quite a challenging gap to fill, isn't it?
Yeah. What do we see day to day? I suppose we see sometimes an issue with the I suppose the ability to link all of your systems into one interface. So let's get my words out here. The reluctance, I suppose, in certain ways to let's say to everybody wants to work together. We have the collaboration piece that we see readily, but we have teams that aren't the credit team who would benefit from viewing our system, okay, the system that the credit team within our customer is using. We then look at means and ways of how do we push information to their system. So let's take an example of the commercial team, so sales team. They won't want to use the platform that's for the credit controllers, okay, or the collectors, the credit manager. They'll want to use their system. So there's an ability with tech now to ensure that they can get access to whatever the credit team are working on, so they can get a view as the other way, but they can do that on their own system. So there's feeds in. There's also the ability to feed in payment behavior to the credit insurer or to the bureau. So all of that is good, but there's sometimes a reluctance. There's a reluctance sometimes to use that. So yeah, it's sometimes it's attitudes from teams that we see. But yes, that's one area that we see.
Thank you, Luke. And if one of our credit leaders on the call today or subsequently listening to the recording was keen to strengthen their existing controls over, I don't know, say the next 6 months or 12 months, but not in the situation to fully invest in a whole technical solution, what would your instincts be on what they should perhaps focus on first?
Yeah, I'd probably look at consolidated exposure visibility. So look at map hierarchies, unify those definitions that we're talking about. So build one exposure view. That's the first one. Second one would probably be behavior-driven monitoring. So recalibrate the risk. So using those behavior signals, not those annual rituals, those annual reviews. Yes, that's what I think we'd be looking at, and also ownership and those classification frameworks and aging. So cash reporting becomes truthful again. That's what we'd look at. Great,
thank you. We're coming to the end of our time together. I'm just going to have a quick look in the chat because I think I saw some questions put up. Yes. Has anyone studied the equivalent of the CICM qualification in another country or found other ways to gain the knowledge we have in the UK market in other markets?
What a great question. What a fabulous question. yeah, we have significant international student body, don't we, Sue, who are taking on the qualifications. Yep, we do see in our client base internationally domicile resident who are taking the qualifications. They're recognised internationally, the CICM qualifications. Yeah. Do you want to add
sorry, Luke, and
yes.
and in addition to that, there's certainly across Europe, there's Federation of European Credit Management Associations, which is FECMA, and they have some individual geographic stuff, some qualifications, some training that's specifically related to their local areas. So it's definitely worth having a look on the FECMA website. And obviously CICM is the founder member. And whilst I'm just talking about FECMA, just in case anyone missed it, it's the 40th anniversary of FECMA this year, and their annual conference is in the UK. It's the first time it's been in the UK for a very long time. It's in London, and for all CICM members, attendance is free, and that includes the lunch on the first day and the gala dinner and the conference. So if you're available on the 11th of June and can get to London, please consider being there, because it's a good opportunity to have the European insight.
Yes, and if I could just add something there, Sue. My DSO manager are a diamond sponsor, so we're going to be exhibiting there. So we are
all right.
We're fully in there. We're supporting not just CICM but also FECMA. Thank you, Sue. Okay. Thank you.
So another observation: resistance to change is always a major barrier. We regularly hear we want to support you, but yes, definitely hear that. And a question from Beverly: do you have anything particular for the Asian market, Luke?
Oh yes. Yes, we are significant in APAC. Yes, we.
So perhaps one for you to link in with Beverly later and provide some extra information.
Absolutely. I was just going to say we are multi-language, 150 different languages. Our interface is 19, but we translate into 150. We have Chinese speaking teams. We have Chinese. We have all the comms. So is it what's the version of the WhatsApp? What's that called in China? Anyway, that's a connector.
Yes, I can't remember, but yeah.
WeChat. That's connected. That's connected to our interface. So yes, we are strong across Far East Asia, APAC region.
Sorry, I was just trying to do two things at once. Then that all went horribly wrong. I won't do it.
Don't worry.
Is there anyone at CICM I can speak to about USA NACAM? Yes, we'll come back to you on that, Lucy. So we're running out of time. Thank you so much for your time and fascinating insight today, Luke. It's been really interesting. I think what has become clear, if we didn't already know, is that we need to keep focus on total visibility across entities. We need to recalibrate the risk on a really regular basis. We need to make sure we can see the difference between what's a dispute and what's an impact on DSO and resolving those disputes, and the wider reconciliation of credit insurance across all the entities that you have in the organization. And I think as operational leaders, I think what I've picked up from the session today is identifying the visibility gaps, knowing where they are so that we can do something about them. That's a key thing. Have a look at the design of the governance. Is it covering the right things? Reorganizing if that's possible without too much drama, and having a look at how systems and controls and structured processes do support. And I think many organizations, particularly in the current climate, might not be in the situation for a full-scale investment on new systems. But I think quite a bit of the stuff that we've learned today, we can certainly gain greater insight to improve what we've got before we get to the investment stage. So I think it's been hugely valuable. Thank you ever so much, Luke, for your time. Thank you everyone for joining. If anybody's got any questions that they didn't get round to asking, please whiz them across to Becky, and we will make sure that we get some answers from Luke and the team and come back to you. This session has been recorded and it will be shared after the event. So any final words from you, Luke?
Just thank you very much for having me. Been delighted with all of the questions and the engagement. And yes, thank you for the questions. And yes,
You're welcome.
thoroughly enjoyed it. Some were tasking, but loved it. Yeah, thank you, Sue. Thank you, Becky.
Always nice
thank
to
you,
see
everybody.
you.
Thank you, everybody, for coming along.
Have a good
Thank
day.
you, everyone.
Bye-bye.
See you soon.
Thank you.